Welcome to Learn Geo. Get ready for an in-depth analysis of the latest news and developments in global affairs, international relations, and technology. In a recent media interview on July 15th, Jim Rogers expressed concerns about the actual debt of the United States, asserting that it far exceeds the officially acknowledged $32.5 trillion. According to him, there is a significant amount of off-balance sheet debt that remains unaccounted for, and the true total debt could already be staggering at over $160 trillion. Rogers also pointed out that the U.S. faced economic difficulties in 2008 due to debt and deficits, and since then, the debt problem has only worsened. He believes that the solution lies in putting a stop to further debt accumulation and promptly repaying all debt to creditors. However, he cautioned that even with debt repayment, there are new challenges, as servicing the debt might require printing more money, leading to potential consequences for the already precarious U.S. economy. Moreover, the U.S. dollar status has been affected as it lacks gold backing, and the U.S. Treasury supporting the dollar are facing uncertainties, creating a sense of instability in the financial markets. On July 14th, the U.S. Department of the Treasury released concerning data regarding the fiscal year 2023. U.S. revenue experienced a drastic 21% drop, resulting in a federal deficit of $1.39 trillion, marking a significant year-on-year increase of approximately 170%. This surge in debt service costs led to a budget deficit expansion, reaching $652 billion, indicating a serious financial challenge. The mounting deficit may trigger pressure from the Republican Party to initiate federal spending cuts, likely sparking heated debates over budget debt appropriations for the fiscal year 2024. In response to the escalating debt situation, some economists proposed that the U.S. government could consider using gold to repay debt and interest, as it is mandated by U.S. law to compensate bondholders. Adding to the concerns, a report from the International Monetary Fund reveals that the U.S. dollar's share in global foreign exchange reserves is at its lowest in 25 years, standing at around 59.36% during the first quarter of the current year. This ongoing downward trend over the past 2 decades is worrisome, and U.S. Treasury Secretary Janet Yellen has repeatedly warned that the decline in the U.S. dollar's status is already a reality. The fall of a currency is often a harbinger of a nation's decline, and the recent banking crises within the U.S. financial system are indicative of the dwindling trust in the country. On July 15th, several senior economists at the Federal Reserve Bank of New York issued a warning that, although the U.S. dollar continues to wield influence over global commodity and foreign exchange transactions, this dominance is not unchangeable. Esteemed economist Jeffrey Tucker shares a similar perspective, viewing recent significant de-dollarization events as a crucial turning point for the dollar. He cautions that the dollar's reign as the global monetary hegemon is unsustainable in the long term, implying potential challenges ahead. It is essential to take note of the trend where global central banks are accelerating the liquidation of U.S. treasuries, alongside several major oil-producing countries in the Middle East actively pursuing de-dollarization. An instance of this shift occurred during the ASEAN Regional Forum in Jakarta, Indonesia, where Russia proposed using its own currency to facilitate trade with ASEAN nations, promoting bilateral trade relations. Russia's efforts to de-dollarize align with similar initiatives undertaken by many other emerging market economies, such as China, India, Argentina, ASEAN, France, and some major oil-producing countries in the Middle East. These collective actions are driving the movement to replace the U.S. dollar's dominance in international trade and financial transactions. During the past year, BRICS countries have made significant purchases of gold reserves, positioning themselves as the leading gold buyers in 2023. These purchases are in line with the BRICS nations' plans to introduce a gold-backed unified digital currency and a new trade settlement currency tied to gold. This move aims to establish a global parallel standard alongside the U.S. dollar. A noteworthy development is that 41 countries, including Saudi Arabia and Iran, have expressed interest in adopting this currency for cross-border transactions, signaling growing support for an alternative to the U.S. dollar in international trade. Additionally, French President Macron has advocated for reducing Europe's reliance on the extraterritorial privileges of the U.S. dollar, reflecting the broader sentiment towards diversifying from the dollar. A recent survey report by the World Gold Council released in July highlights that over 30% of central banks plan to continue increasing their gold reserves, underscoring the strategic importance of gold as an asset. Gold's unique attributes, including its lack of credit risk and non-depreciating nature, are prompting a re-evaluation of the credit risks associated with U.S. debt. As a result, gold's role as a currency and a hedge against economic uncertainties is gaining prominence. Moreover, in a significant move, the authorities in Tennessee, U.S., revealed plans to create an officially gold-backed digital currency. This would enable U.S. citizens to use the digital currency for everyday transactions, offering an alternative to traditional fiat currencies like the dollar. This points towards the emergence of a gold-backed digital currency as an alternative to the U.S. dollar, aiming to restore credibility lost due to the dominant influence of the U.S. Federal Reserve and the U.S. Department of the Treasury. In the current stable monetary system, there are warning signs concerning the U.S. dollar, and a growing trend of distrust is spreading. In the past month at least, 4 U.S. lawmakers urgently called for the reinstatement of the gold standard, and more than 10 states in the U.S. have officially recognized gold as legal tender. This reflects the resurgence of gold as a natural reserve of wealth and a currency function within the U.S. monetary system. Simultaneously, China is accelerating the liquidation of U.S. treasuries to bolster its gold holdings. According to the latest data from the World Gold Council's 2023 Central Bank Gold Reserve Survey, China imported 546 tons of gold from Europe and the United States in the first 4 months of this year, marking the highest quarterly import volume since 2015. In the previous 3 years, China had already imported a substantial 2,381 tons of gold. The most recent data from the People's Bank of China released on July 7 indicates that China added 74 tons to its gold reserves during the first 6 months of this year, marking the 8th consecutive month of gold reserve accumulation after breaking a 38-month streak. Without reporting an increase in gold reserves in November of the previous year, China has steadily added a total of 165 tons of gold reserves as of June this year. A substantial 620 tons of gold have been shipped from the gold markets of the United States, the United Kingdom, and Europe to China during the past 12 months. China has been a net seller of U.S. treasuries in 11 out of 12 months, maintaining holdings below $1 trillion for a year, and lowering its position to a new low of $868.9 billion, the lowest level in 13 years. This trend of reducing U.S. treasuries holdings continues. The Gold Demand Trends Report exemplifies China's robust and sustained demand for gold, elevating non-U.S. assets including gold to a new strategic level. These developments demonstrate China's strategic focus on diversifying its asset holdings and reinforcing its gold reserves amid changing global economic dynamics. On July 15, Zero Hedge reported that in the event of the U.S. budget dispute persisting into 2024 and the banking crisis spreading, which would raise the credit risk of U.S. financial institutions, global central bank cornerstone buyers of U.S. treasuries, such as China and Japan, might decide to sell up to $700 billion worth of U.S. treasuries. This move aims to avoid potential restrictions on their foreign assets and to reduce their exposure to U.S. debt. Furthermore, if uncertainty increases, leading to potential defaults in U.S. agency bonds and government bonds, China may consider liquidating its holdings of U.S. treasuries. Such actions could expedite the process of global de-dollarization. In a report on May 11, Moody's economist Bernard Yaris drew a comparison between the potential destructive impact of this debt deadlock and the 2008 U.S. financial crisis. This situation underscores the seriousness of the implications and the risks associated with the current state of U.S. debt and its potential ramifications on the global financial landscape. This situation will have a detrimental impact on the creditworthiness of the U.S. economy, given the existing lack of trust within the U.S. financial system. As a result, investors may start to question the value of U.S. bonds. U.S. treasuries, which have long been regarded as the bedrock of the global financial system, could face significant challenges due to these developments. The reputation of the U.S. Treasury market as the safest and most liquid asset worldwide may suffer. U.S. Treasury Secretary Janet Yellen communicated a critical warning to Congress on July 14, stating that if another debt budget dispute arises in October this year, the situation will become dire. Should the debt controversy persist alongside regional bank failures and high interest rates leading to credit tightening, the stability of U.S. finances will be severely compromised. This in turn will seriously impact the U.S. dollar's status and reputation as a global reserve currency while simultaneously weakening the role of U.S. treasuries as a traditional safe haven asset. Certain lawmakers in Congress are contemplating the idea of producing $1 trillion worth of gold coins, which would then be deposited with the Federal Reserve and utilized to repay debts and interest owed to creditor countries like China. Nevertheless, Yellen has asserted that there are no plans to commit to paying off U.S. Treasury debt to creditors, including China, in situations where the U.S. cannot fulfill its entire debt obligation. Thank you for tuning into this video. We look forward to seeing you in the next one.